Good morning. It's great to be back in the United States, the Pacific Northwest, where it's considerably cooler than it was at home in Japan. Wonderful trip. Thank you so much for paying attention, watching, following along, reading along. We spent great time with family, friends, visiting with dear friends, including the fabulous Susie Orman and her wife KT, who, by the way, are a riot to travel with. Anyway, I'm not sure if my mind or my body is halfway across the Pacific just yet, but my batteries are recharged, and that's where I suspect plenty of great coffee will come in. So here's the thing about Japan that I love and miss the moment I leave. I don't know if you've ever been there, but time works differently in Japan. Not in a jet lag way, though. Well, that too. But in a way that, a 400-year-old temple sits serenely next to a vending machine selling hot canned coffee. And neither one finds the other one remotely strange. One of my favorite things to do, you can walk into a garden that's been there centuries and it hasn't changed one bit. And the noise in your head just stops. It vanishes. It's amazing. The urgency evaporates. The markets, headlines, whatever X is screaming about that day, none of it follows you through the gate. Japan is the one place on earth where I can genuinely lose track of what day it is and don't even care a little bit. But here I am. We're back on Pacific time and back in the game. And as I mentioned in my Sunday short from Kyoto, we have a big week ahead. And I'm very excited. So, as always, let's get after it. Thanks for watching. There is a ton of profit potential out there right now at the moment. And I say grab your share or somebody else will. What a great time to be an investor. Anyway, there's an image that makes all of this abundantly clear in the written version of the Five with Fitz. I call it the sixth wave. I want you to take a good look at it because I think it paints a compelling picture as to where we're going over the next 5 to 10 years and why, as an investor, you and I want to be along for the ride. So anyway, number one today, how markets keep going up despite high rates, gasoline, and more. There is nothing on earth like jumping back in the pool with both feet. Hoo-yah! As far as I'm concerned, because sometimes it's cold, but nonetheless, it's great. The venerable Stuart Varney kindly invited me back this morning ahead of today's opening bell for a look at how and why markets continue to rise despite three otherwise super negative influences, not the least of which are rising rates, but gasoline, inflation, and consumer sentiment. So anyway, there's also my take on nvidia and Walmart, both of which report this week and both of which are going to be critically important for investors in the markets alike. You can watch that video elsewhere on my channel. Please do. I think it's going to be interesting. And dare I say it, hopefully profitable. Anyway, number two, this was interesting. Is it time to buy Berkshire Hathaway? Now, I've stayed away from Berkshire Hathaway stock for years because I didn't get the sense that Uncle B, as in Warren Buffett, really understood the rise of AI, among other things. And I'm glad I did. BRK has trailed the S&P 500 for years, and badly at that. But now I find myself wondering if it's time to buy. New CEO Greg Abel just cleaned house, boosting the number of shares in Google by 224% that BRK owns, adding Delta, which if you're going to add an airline and own one would be my choice, and Macy's, which I don't quite understand, but clearly he sees something. Now, I think, interestingly enough, what Abel's dumped is speaking volumes about the market. Visa and MasterCard, both gone with the wind. Domino's, poof. Amazon, see ya. Diageo, out of here. Charter Communication, bye-bye. Anyway, interestingly, B of A and Apple were both spared. So, Now, scuttlebutt is that longtime Buffettiti, meaning those who follow Buffett, are terrified by the changes, but those who thought that he outstayed his welcome are thrilled. Now, my POV personally is that A, you can't turn an ocean liner overnight, and B, when a new leader starts ripping up the playbook, that tells you something about where he or she thinks the world is headed. Either way, and regardless of whether you agree or not, it's worth paying attention. So, Keith's investing tip in this department, buy the best, ignore the rest. The time to evaluate a new captain isn't when they first grab the wheel. It's after you've seen how they handle the first real storm. All right, number three today. No, Trump didn't come away empty-handed. Russian President Vladimir Putin will be traveling to Beijing just days after U.S. President Donald Trump's visit to meet his Chinese counterpart, Xi Jinping. Now, the two leaders will discuss, according to their press releases, current bilateral matters, ways to further strengthen the comprehensive partnership and strategic cooperation between Russian Federation and the People's Republic of China, and exchange views on key international and regional matters, end quote, according to the Kremlin. Now, translation is, okay, Xi, Uncle Vlad wants you to spill the beans on what just happened with President Trump. Anyway, the visit comes just days after U.S. President Trump wrapped up his own meetings with Xi Jinping, showing how seriously Moscow is watching Washington's every move in Asia. Now, around the world as well. Now, my POV is the fact that there isn't a new policy on Taiwan, which a lot of the West doesn't understand, is a win for the world because it means that all three parties, China, the U.S., and Taiwan, understand each other. They may not agree, but they understand each other. And that is what's really critical because it avoids the hard line that would inevitably come with making it a political issue in three capitals simultaneously. Now, my expectation, having watched Chinese deals and summits and those kinds of things from that part of the world for decades, is that I expect big new deals in China and with China over the next 6 months as a result of discussions and groundwork laid this trip, starting, of course, with big tech. So, Keith's investing tip, I have long said that you want to invest because of China, not necessarily in China, with very few exceptions that, of course, the OBA family knows all about. If you're one of them, you know exactly what those are. If you're not, I invite you to take a look. You might find it helpful. Number 4 today, Meta's nightmare could get worse. Now, this is intriguing because more than 3 years after El Zucco said, my bad, when it came to job cuts, the company is handing roughly 10% of the workforce their walking papers starting Wednesday of this week. And CNBC is reporting that the company has also scrapped plans to fill 6,000 open roles. Now, call me crazy, but this is coming right from the C-suite where the tone has changed remarkably. My 2 cents is that lawsuits and crappy stock performance have a way of doing that. So what do you do if you own Meta? Well, I think that's a legitimate question at this point. I want to own it, and I recommend doing so through a back door using a large fund to help keep risk down. But I've stayed away from the stock itself directly because, frankly, I still don't trust Zuck himself. There's an ongoing emergence of some sort of dystopian empire with huge swaths of Meta employees apparently voicing increasingly harsh and revealing comments about what it's like to work there. And that's not exactly inspiring to me as an investor. You may feel differently, but that's just my 2 cents. And number 5 today, NextEra. Here is what dividend investors aren't asking yet, but should. NextEra is buying Dominion Energy, the utility that powers the world's largest data center market in Northern Virginia, and it's a $67 billion all stock deal. So, the dividend crowd, of course, is cheering, and that's great, but I think it's premature in my humble opinion. And here's the question nobody's asking. What does this $67 billion all stock deal do to the dividend? Well, NEE, NextEra Energy's stock fell more than 4% on the announcement. And that's the market doing the same math I am on potential dilution, integration costs, and regulatory risks. And they should, because this is the largest power sector M&A deal on record, certainly that I can recall. Deals of this size don't exactly sail through FERC, FERC, and the Federal Energy Regulatory Commission, or whatever they call that thing these days. And it's not going to sail through 4 state utility commissions without conditions, delays, and real money spent fighting for approval. Now, regulated utilities are supposed to be boring, folks. This deal is the opposite, and that's dangerous to investors. I mean, look, right? The AI power demand is real, I get it, but I'm concerned when state utility executives start acting like growth experts for the simple reason that that's not in their skill set. If you remember your history, I think back personally to the late 1990s. Pacific Corp, a great company, did much the same thing when it went on a global buying spree, acquiring the Energy Group, a sprawling UK and Australian coal conglomerate for $10.7 billion. Yeah, I know, chump change these days, right? Anyway, executives got completely over their skis, the company buckled under the debt, and Pacific Corp had to be rescued by Scottish Power. Think about that for a second. Shareholders got crushed in the process. So this time around, if you own NEE already, I think keeping it probably makes sense if it fits with your risk tolerance, circumstances, and objectives, which I, of course, don't know, so I'm speaking generally. But if you're eyeballing it potentially as a new investor, I respectfully submit that there may be better alternatives out there without the monster mergers attached. Seems to me that there's some other more direct ways to get the AI-driven dividends and growth too. Now, OBAers, of course, know exactly what I'm watching. You can click on that link in the written version if you'd like, or join us at the party. Either way, Keith's investing tip, the best dividend are still the ones that are growing 5 years from now, not the ones that look good today necessarily. Not always the same math. Bottom line, missed opportunity is always more expensive than trying to avoid risks you can't control. So as always, let's make it a great day and start the week strong. Thanks for watching. Thanks for returning. Now that I'm back, I'll see you again tomorrow. Cheers.